The financial world has long relied on metrics to assess the health and trajectory of markets. From the CAPE ratio to the Buffett indicator, these tools offer a lens through which investors attempt to decode the ever-changing dynamics of valuation and speculation. Among these, the emergence of the Saylor-Buffett Ratio, a comparison of the returns of MicroStrategy and Berkshire Hathaway, provides a unique perspective on market behavior, particularly in times of speculative fervor. Historically, peaks in this ratio have often coincided with market bubbles, and its current upward trajectory sends a stark warning. The market may be teetering on the edge of significant overvaluation. To understand its implications, we must delve into the ratio's origins, the broader market context, and the eerie parallels to past speculative manias. For instance, during the dot-com bubble, the market favored high-growth, unproven tech companies at the expense of traditional industrial titans, a dynamic that ended in dramatic reversals once reality caught up with valuations. Today, the ratio's climb suggests that speculative narratives, particularly around AI, cryptocurrency, and high-growth tech stocks, are dominating market sentiment. This is not an indictment of innovation, but a caution against excessive euphoria detached from financial fundamentals. The current market environment bears striking similarities. Companies like Nvidia and others in the AI and semiconductor space are enjoying surging valuations, with their market caps driven less by earnings and more by expectations of future dominance in AI. At the same time, we see speculative interest driving the valuations of companies with tenuous connections to real-world profitability, reminiscent of the pets. The role of monetary policy further complicates the picture. During the dot-com bubble, an era of loose monetary policy helped fuel speculative excesses. Today, despite higher interest rates aimed at curbing inflation, market participants have adapted by chasing returns in speculative assets, exacerbated by the concentration of wealth in high-growth tech sectors. The Federal Reserve's rate hikes have failed to cool certain pockets of the market, leading to distorted valuations in AI and cryptocurrency-related stocks. Meanwhile, traditional sectors such as manufacturing and consumer goods face headwinds, creating an uneven market landscape. The Saylor-Buffett ratio also highlights the psychological dynamics at play. Investors are drawn to narratives of exponential growth and transformative innovation, even when the underlying fundamentals don't justify the valuations. Behavioral finance teaches us that fear of missing out, or FOMO, often drives speculative bubbles. As investors pile into high-performing assets, they create a feedback loop, pushing valuations even higher and attracting more speculative capital. This phenomenon isn't new, but its amplification by social media and algorithmic trading creates unprecedented risks. Another concerning indicator is the divergence between market capitalization and economic output. The total market cap of U.S. equities as a percentage of GDP, also known as the Buffett indicator, has reached historic highs. This suggests that the financial markets are decoupling from the real economy, a hallmark of speculative bubbles. During the dot-com era, this ratio also soared, driven by the overvaluation of tech stocks. When the bubble burst, the correction was severe and prolonged, affecting not just investors but the broader economy. It's crucial to differentiate between transformative innovation and speculative excess. The AI revolution is real, and companies like Nvidia are at its forefront. However, history shows that even revolutionary technologies can experience valuation bubbles. The railway mania of the 19th century and the internet boom of the late 1990s both transformed the world, but left behind financial carnage when speculative exuberance outpaced reality. For investors, the lesson is clear. Be cautious of valuations that rely heavily on future growth assumptions. Diversification, thorough due diligence, and a focus on fundamental metrics are essential in navigating speculative markets. Regulators and policymakers also have a role to play. The systemic risks posed by speculative bubbles can have far-reaching consequences, from financial instability to economic recession. Ensuring transparency, enforcing fair trading practices, and monitoring market concentration are critical steps in mitigating these risks. The Saylor-Buffett ratio serves as a timely reminder of the dangers of speculative excess. As this metric climbs, it reflects not just the divergence between speculation and value, but also the broader vulnerabilities in today's market. Investors must remain vigilant, recognizing that history rarely repeats but often rhymes. The lessons of past bubbles, from the railway mania to the dot-com bust, underscore the need for caution, discipline, and a focus on fundamentals. While the age of AI promises transformative innovation, it's essential to separate the signal from the noise, ensuring that the pursuit of growth doesn't come at the expense of financial stability. As the Saylor-Buffett ratio rises, it's not just a reflection of speculative fervor but a warning to all who seek to navigate these turbulent markets. If you like this video, please hit the thumbs up and subscribe buttons.